talk with Howard Marks. My name is Volker Farnhold. I work for PMG. We're an independent fund management company in Zurich, and PMG launched in 2009 the Cancer Charity Support Fund, for which we have created this event. So before we start, I'm thrilled to present to you Bettina Juncker. She is a member of the board for the Swiss Cancer League. She'll have some introductory words. After that, we have Remy Reichmuth from Bank Reichmuth, who is one of our partners in the fund and who will also have some welcoming words to you. With that, I pass on to Bettina.
Thank you very much, Volker. Thank you, Mr. Marks, for being here. Good morning, everybody from my side. First of all, again, thank you, Volker, for letting me be here, for inviting me, and for giving me the opportunity to say a few words to express my gratitude for the work you do. I'm very honored to be here. Let me quickly introduce myself. My name is Bettina Juncker. I am responsible for fundraising, marketing, and communication at the Swiss Cancer League and the Swiss Cancer Research in Bern. The Swiss Cancer League, you might know it, is a very old institution. It's 107 years old. The Swiss Cancer Research is 26 years old this year. So ever since these institutions have been in existence, we are working towards a world in which fewer people fall ill, fewer people suffer from the consequences of the illness, and more people can be cured. We also know it, despite the impressive success and progress we are making in cancer research, the battle against this terrible disease is far from being won. So cancer remains a terrible threat to all of us, and there is still a lot that needs to be done. But the good news is, it is thanks to people like you, Volker, like everyone in here, who support us in the fight against cancer, so that we can continuously provide support and help to those who need it. Both the Swiss Cancer League and the Swiss Cancer Research are almost entirely donor financed. So in order to be successful, we need your support. You can do it by different ways. Today we have produced a sheet. You've all seen it probably on your seat. You have either the chance to sign for the Swiss Cancer Charity Support Fund or make a donation to the Swiss Cancer League. You can, after the investment talk, get a signed copy. Mr. Marks was kind enough to propose this even. You can get the signed copy while you make your donation or while you sign to the fund. So before the investment talk starts, I would like to thank all the supporters of the Swiss Cancer Foundation who came up with the idea to create this Cancer Charity Support Fund in 2009, I think it was 8 years ago already, and who continuously support this initiative even today. You know it probably better than I do that in the Anglo-Saxon world, it is quite usual for the financial community to support charities and to raise money for a good cause. In Switzerland, we're not quite there yet, unfortunately, but it is great to see such an initiative like the Cancer Charity Support Fund and the investment talk today in Zurich. That's simply fantastic. So this is thanks to you, Volker. I need to repeatedly say it. And thanks to all the people working at PMG who launched this highly innovative vehicle back in 2009. And thank you for establishing these investment talks and thus creating an excellent discussion platform, networking platform for all of you to share your thoughts and to get inspired. Your personal commitment, Volker, where are you? Your personal commitment is outstanding and it is highly appreciated. So thank you very much.
Thank you.
Moreover, I'd like to thank all the private and institutional investors into the Cancer Charity Support Fund. They donate half of the annual performance to the Swiss Cancer League and Swiss Cancer Research. With their long-term investment horizon, and this is really important, they're an important pillar and strong financial support we can rely on. It is very good news that the group of supporters is constantly growing, and I'm particularly happy to have one of them here with us. It's Remy Reichmuth from the private bank with the same name. Welcome, Remy. Thanks for being here, and I'll hand over the stage to you. Thank you very much.
Thank you, Bettina. Just a few words from my side. My name is Remy Reichmuth. I'm a partner, a member of the management board at Reichmuth & Co. At Reichmuth & Co. we focus on advising wealthy individuals and institutional clients on a very personal, or as we call it, integral mindset. Often charity is also part of such a comprehensive, integral overview on one's financial targets. And that's why we founded Rütli Stiftung, our Rütli Foundation, back in year 2000, through which our clients can realize their very individual charitable activities. I'm honored that together with PMG and Krebsliga Schweiz, we add to this our activities for the Cancer Charity Support Fund, and we took over as a custodian bank last year and do our best to help to add to the success of the fund and helping increasing the donation. And now to something completely different. You all know the famous book Das Kapital from Karl Marx, and you might know that last summer a signed copy of this book fetched $250,000 at an auction. I think it was in London. And as Bettina mentioned, we have or PMG organized that we have a few signed copies of another book from an author called Marx, Howard Marx, and he will sign a few books afterwards. So I'm sure it is full of innovative ideas and much more readable than Das Kapital. So the deal is, if the first four who manage to get their donations to the Krebsliga or subscribe to the fund will get a signed copy with a personal note, and also the two most generous. That's what I call a win-win situation, and before I hand over to our host, I'm very much looking forward to the talk, and thank you for your attention. Thank you.
Thank you, Remy. Our guest of honor today is Howard Marks. Obviously, he doesn't really need a big introduction. He is the co-founder and co-chairman of Oaktree Capital, a company that was founded in 1995 with a team that already previously worked together for 10 years. The company has built a significant, one of the most consistent, the most successful track records in high-yield bonds, convertible bonds, and along the way, it created a very respected and profitable private equity business. So we're excited to hear about that. Howard Marks is legendary for his memos that come out basically since the beginning of Oaktree Capital. And some intelligent person asked him, how do you put this all together and what is really the most important thing of investing? And so he came up one day and wrote this book, The Most Important Thing, which is up for grabs later on. And what we have here is actually the most important thing illuminated, which is even better than the original, I presume, because it was annotated by some of the most respected and best known investment managers of today. So we're very excited to have you here. Thank you for spending time with us. Now in Europe, there's a time like with the US. We wake up in the morning, we check our mobile phones for the latest news from the US, and these days we're bound to read something unusual every other morning.
Unusual is a kind word.
That is a direct effect of the new administration. Now, my question, what has it done to you? Have you started to log on to Twitter? Do you get direct messages from the president these days?
No, I think that I'm not a social media user. And I will say that during the campaign, I, like almost everybody else, got addicted to watching the news 24/7, and I had the apps for all the various sources. But one of the important lessons of this election was how wrong everybody was, and also how much time everybody wasted by just watching. So I put out a memo called Expert Opinion in January, because I don't have a very high opinion of what passes as expert opinion. And I talked in there about how desirable it is really to disconnect from the daily events and try to have a bigger focus. And I said that most people would be more productive and more serene if they did not watch every day. So I tried to carry that out as well. Now, of course, we can't disregard what's going on. By the way, I quoted in there from a wonderful newspaper article that came out shortly after the election, or blog, or whatever you want to call it. I'm not even sure of the right terminology these days. But, and the writer said, I root for the New Orleans Saints football team, and I will still watch the Saints every Sunday. But now I have disavowed the belief that if I watch the sports show on Tuesday, it's going to affect the outcome. And I think that should be true of all of us. It's almost like idle curiosity to watch all the commentary. It's sufficient to just know what's going on. Now, as to the new president, I think I view it in three aspects. Number one, there's no, the market has taken off from Election Day, November 8th, and shortly after the election, I put out a memo called Go Figure, and I said in there that the day before the election, we were sure of two things. Number one, that Hillary would win, and number two, that if Trump won by some odd quirk of fate, the market would collapse. So instead, Hillary lost, and the market went up. Go figure. And the point is, the important message is, we don't know what events are going to happen, and we don't know how the market is going to react to the events that happen. And I think we have to, a big part of my belief is that we have to suppress our belief in our own omniscience, and we have to understand how much it is we don't know, and make room for that. But in thinking about Trump, number one, the one thing that is for sure is that he intends to be an extremely pro-business president, much more than Obama has been, much more than Hillary would have been, in my opinion. Hillary's rhetoric on the campaign trail was not very pro-business, and I think that would have largely followed through. When I was a young person in the investment business in America, we used to have a saying, what's good for GM is good for America. And I don't think that Obama was antagonistic toward business, but he just didn't believe that. And there are a lot of people who take our prosperity for granted and don't ask where it comes from. And I think that it comes from the efficiency of business and the wonders of the private market system. free market system. And I don't think that Obama knew that. I mean, there's just no reason to believe that.
But on the
so-
other hand, if you look at the current president, does he have his priorities right if he's really wanting to support business?
Well, I think that I think he's more short-term oriented than I would be. And, you know, for example, to be pro-business and to deny climate change, for example, is a contradiction in terms. I think that...
What about free trade?
Well, and there's another example, yes. And I think that, you know, look, I don't think it comes as a shock to anybody in this room to hear me say that I don't think he's a deep thinker. But you know, to say we're going to improve taxation, we're going to bring back the stranded earnings that are offshore, we're going to deregulate, we're going to build infrastructure. All these things are glossy, short-term help for business. And I don't think he makes the connection to the long term of international trade, climate change, and so forth.
But the market, which apparently is such a long-term weighing machine, is celebrating his presidency. What do you make of that?
But I think that the market is responding to the short-term things that I mentioned. And, you know, the idea of deregulation and tax reform and reduction of corporate tax rates and infrastructure spending is appealing on the surface. And, you know, look, the market's been going gangbusters. So number one, he intends to be pro-business. Whether he does the right things as a result in that context and whether they work is uncertain, but on the one hand, pro-business, pro-economy. Number two, everything else. You know, and I think everything else is pretty much of a mess. But, you know, it's hard to separate one's political opinions from that. I imagine he's doing things that his supporters think are good, constructive for society. I don't know what they are. But anyway, I think that I have severe questions about climate change and the effect on society in terms of social interaction and openness, equality, and so forth. And then number three is just the daily events, you know, of what inappropriate thing has he done today, and you know, what protest is taking place, what lawsuit is being filed, what scandal is he engaged in, what tweet. And I think that these things will on the one hand, will keep us on edge for the balance of the 4 years, but on the other hand, human nature tends to become inured to these things, so maybe it'll settle down. You know, was the Trump election good news for society? I don't think so. Was it good news for business? Maybe in the short run, but certainly the market has cast its vote.
So what's your explanation for the market performance as of recently?
Well, as I say, I think that people are giving him the benefit of the doubt. And, you know, there's an enormous tendency of people to vote their wallets. You know, the guy could be a terrible guy, he could be a nut, he could be irresponsible, he could be, you know, not much of a student of history or economics, but if they think he'll make them richer, you know, most people form a favorable opinion and vote their pocketbooks. And Charlie Munger always quotes from the philosophies Demosthenes, who said, for that which a man wishes, that he will believe. And, you know, everybody wants to be richer, and at this point, they're tending to believe that Trump will make them richer. And, you know, I don't think they're the people who move the markets, but his supporters naively look at him and say, look, this guy's worth $10 billion. If he can do that, then clearly he can make America prosperous and make me better off. I don't think these are the people who are casting their votes in the stock market every day, but I do think that that is how people are naively, in my opinion, looking at him.
So the Schiller PE is above 29 last time I checked. That's by historical standards very expensive.
Yes.
What's your reading of the market?
By the market, you mean the U.S. stock market?
The US stock market,
Yeah.
yes.
Well, of course, the Schiller PE has been in the high 20s for a very long time, and in that sense, it hasn't been predictive. On the other hand, we all know that the fact that something is overpriced doesn't mean it's going down tomorrow. You can be wrong for a long time. I think it's been wrong for a long time in that sense. That doesn't mean it should be disregarded. But if we look at the S&P normal PE, which I'm more familiar with, you know, now it's 19 or so. Is it 19 today? Yes. And, you know, we're not involved in the stock market directly, so I don't deal with it every day. But I think the PE ratio is about 19. The historic average is 16. So if you look at that, you would say, okay, it's overpriced. It's a little rich, but it's not ridiculous. You know, in 2000, the PE ratio was, I think, 32. So that was a bubble, and that was dangerous. I don't think 19 is dangerous. It's just a little high. So that means that it could soften or it could pause while earnings grow into the numbers. So I would say a little rich. On the other hand, I have to say that when you compare it with the post-war average of 16, clearly for the post-war, for the 50 years or the 60 years of the post-war, growth was higher. So if growth is now lower, which appears to be the case to me, then perhaps the PE ratio should be lower as well. So maybe the 16 is not the relevant standard. Lastly, I think Warren Buffett said the other day, the stocks are not too expensive because interest rates are so low. That's a justification at the moment. It may not work in the long run because in our country, interest rates are not going to stay so low. So if interest rates go higher, then that argues for lower valuation for stocks. So I guess what I would say overall, Volker, and what I say to everything is that things are on the high side of fair or the beginning of rich. There are no bargains around. There's nothing you can buy today which is demonstrably below its intrinsic value. I think that people should be cautious.
Now, if you look,
doesn't mean sit in cash, but you know there are lots of ways to exercise caution short of disinvesting.
now if you look at the bond markets, high yield spreads are at multi-decade lows. They're extremely tight. Credit metrics are weakening. Leverage is rising. Credit markets are being flooded with people who are looking for yield. The 10-year Treasury yield, general level of interest rates is at multi-decade lows and likely to rise, we don't know when, but sometime. What do you make of the situation in the bond markets?
Well, it's similar. You know, everything has been dominated for the last 8 years by the reduction of the risk-free rate by the central banks. There's a line, and it looks like this, and this is promised return, and this is risk, and it starts here with the risk-free rate, and if we go back 20 years, the risk-free rate was 4, and everybody says, well, if I can get 4 from the risk-free rate, I'm not going to tie my money up for 5 years in a treasury unless I get 5. If I can get 5 on a 5-year, then I need 6 to do the 10-year. And if I can get 6 on the 10-year, then I need 12 to do high yield. And if I can get 6 on the Treasury, then I need 7 if I'm going to go into corporate high grades. Why should I take credit risk if I don't get another point? And if I can get 7 on a corporate, then I shouldn't go into the S&P unless I think I'll get 9, and speculative stocks 11, and real estate development 15, and private equity 25. And you get a line like this. Then the central banker comes along and he pulls on the bottom of the line. And he says, no, I want the risk-free rate to be 0. So then the 5-year Treasury becomes 5, and the 10-year Treasury becomes 1, and the 10-year Treasury becomes 2, and the high-grade bond becomes 3, and the high-yield bonds become 6, and it's all the same thing. Now, the question of whether the shift of the line has been parallel or not is another question, or has the slope changed? The slope indicates the risk premium. But the point is, most of what's wrong with our markets today starts with interest rates of 0, and everything else calibrates off of that, and that's where we are. We're in a low return world. It's very simple. The first worried memo I wrote in the last cycle was November 04. It was called Risk and Return Today, and I talked about the fact that we'd had this downward shift, but at that time the line not only declined but it also flattened. And if the line flattens, that means the unit increase in return per increase in risk is low, small risk premiums, and that's not a good time to take risk. But today, I don't think it has flattened as much, in my opinion. But the point is, we're living in a low return world. And we have to accept that as a given. We can't change it. You can't say, no, I want a different world, and go next door and try to find a different world. We're stuck in a low return world. And the question is how to behave in a low return world. And you can accept the low returns. You can stay in cash waiting for the environment to change. You can say, I still insist on making high returns in a low return world. The way to do that is to take more risk. And, when the line was here, you invested here. Treasuries, investment grade bonds. Now the line is here. To get that return, you have to go out to here. And a lot of people have done that, and they find themselves in high yield bonds. I imagine the mutual fund investor in America watching football in January, and he opens his statement from Fidelity, and it says your money market fund now yields 0. Your intermediate treasury fund now yields 0. So he grabs the 800 number and he calls Fidelity and he says, get me out of those funds that yield 0 and put me in the fund that yields 6. Now he becomes a high yield bond investor. He doesn't know what he's doing. He doesn't know the risk he's taking, doesn't know the importance of, if you're going to do that, doing it in a controlled risk fashion. He just moves into the 6% fund and he thinks he solved the problem. So we have a lot of what I call pro-risk behavior taking place today. You described it yourself. And, one of the better memos I ever wrote was in February of 07, just before the crisis, and it was called The Race to the Bottom. And it talks about what happens when there's too much money chasing return, and people are not appropriately concerned about risk. And we've gone somewhat back there.
Now,
But I want to say one thing. I don't think it's true that spreads on high yield bonds are at multi-generation low, because I think the spread on high yield is about 450 today, and if you go back to May of 07, I think it was 250. So by that standard, they're still generous. And historically, if you bought high yield bonds when the spread was 450, you had an extremely high probability of outperforming treasuries. Spread is a commentary on relative return prospects, not absolute return prospects. And I think that buying them today at 450, I think there's an enormous probability that you will outperform treasuries. And the question is that enough?
Now, I haven't heard you talk about the prospect of an unwind of this situation with central banks pumping liquidity in the market.
Yeah,
It's
yeah.
clearly not going on forever. It'll unwind.
Yeah.
Do you have a view on how this unwind can take place? You have the benefit of history, so to say, as you've been around in the 70s, actually managing high-yield bonds and convertible bonds when interest rates
Yeah.
went massively up. What's the
Well,
message?
Well, I mean, the bottom line is simple. If you have a call on a promised stream of interest and principal in a given investment environment, and demanded interest rates go up, then the current price goes down to compensate, to provide the demanded higher return. That's not a pleasant experience for the holder. You know, if we're in a low return world today, and if 3 years from now we'll be in a higher return world, there's two ways to get there, but really only one. One is that fundamentals get better, growth accelerates, et cetera, and the problems are resolved. And the other is prices go down, so that the same asset offers a higher prospective return at the new lower price. That sounds very admirable, not fun for the holder. So I think but on the other hand, I don't think we're going to have interest rates rising fast or far. That's you know, everybody has been massively preoccupied for the last, you know, it was May the 22nd of 2013 when Bernanke said, I think you're going to see signs of reduction of our bond buying. And everybody's been worried about rising interest rates since then, preoccupied. And everybody acts as if rising rates are a bad thing. And the answer is, rising rates are not a bad thing if number one, the central banks are raising rates because they believe the economy will be strong, and number two, if the increase will be moderate in amount and gradual, which I think the events clearly show it will be. The economy, even in the U.S., is not strong enough to call for rapid, massive increases in rates. The main reason why you get rapid, massive increases in rates is to cool off inflation. We don't have that much inflation and that much inflation worry. So I don't think you're going to see rapid or huge increases in rates. We will see gradual increases in rates to a moderate level. You know, in 07, all the money I had in the world outside of Oaktree was in 5-year treasuries, and they paid 6.5. I don't think we're going back to 6.5 on the 5-year treasury anytime soon. You know, but if we got to 3 or 4, it would seem like a big increase, but not terribly injurious to financial well-being. Look, you mentioned earlier that high-yield bonds is one of the main things we do. I look at high-yield bonds. People say, well, is high-yield bonds, are they good today or bad? Let's say they yield 5.5 today in the U.S. What I would say is, if 5.5% will help you solve your financial goals, you should buy them. Because if they pay, if they don't default, you'll get 5.5.
But that's the key question, if they don't default.
Well, the answer, so you have to find a manager who is skillful enough to avoid most of the defaults. Defaults are not a big deal.
Like who, for example? Do you have anybody in
Well,
mind? Just kidding.
But I mean, look, in our history, 1.3% of our portfolio has defaulted every year for the last 30 years. And when you have a default, let's say you lose 2/3 of your money. So 1.3 becomes 0.8. So the 5.5 your promise becomes 4.7. Still, in this environment, a decent return. But the point I'm trying to make is this, Volker. And by the way, there's a theory that, you know, we're going to have very low defaults because business is healthy. Usually that is a theory that comes into existence when business is in good times and usually gets tested in bad times. But, you know, the default rate has been very low for the last 7 years. But let's leave that aside. But the point is, let's say that high-yield bonds are going to give 5.5% net of credit defaults over the next, you buy a bond today, or portfolio bonds, and 10-year bonds, and over the next 10 years, they're going to give 5. The most important thing is people should not buy 5-year bonds to get 8%. Makes no sense. If 5 is a good number for them, they should buy it. And if if interest rates go up, the price will go down to enhance the return over the remaining life. But if you buy today, price goes down, then it pays off at par, you still make your 5%. Is 5% a good return for you or not? The great thing about bonds, which you know, I spent my 10 years first in equities, and then I moved to the bond world. And bond world and stock world is so different, because what you have with bonds is you have a promise, a contractual promise of interest and principal. In the stocks, there's no promise of anything. If you buy a bond today and it doesn't default, you'll get the promised yield. And the question is that adequate or not? But the fact that you can rely on repayment X years out is a huge advantage over the stock guy, where all of his return in the short to intermediate term comes from the market. And so you have to say, well, what's the market going to do? The bond guy really doesn't have to wonder about the market, because he knows he's going to get his promised return over the life of the instrument. And that's not the worst thing in the world. You know, so if you buy it today at par, interest rates go up, it goes down to 85, and then it pays off at par, not the end of the world. And the point is, today, what's better? That's really the issue. You can't compare today's investment opportunities against the investment opportunities of 20 years ago. You can't compare today's opportunities against the opportunities you wish you had. You have to compare them with the alternatives today. What's better? And it's hard to say. And if you are worried, you know, you seem like you're pushing me in a cautious direction. If you're worried and you don't go in bonds, what can you do? Everything else is basically less safe than bonds. Now, you could go into higher quality bonds and have a 0 to negative yield. I don't think that's an improvement. Mm-hmm. So, I mean, I think this is kind of a sweet spot that I would stick to in a low return world. By the way, in my memo of 04, I had one other suggestion, if you don't like any of those suggestions, and that is what I called special niches, special people. You can try to find managers who have alpha, who can add to the return in excess of what the market gives. Special people who have high skills and can outperform. And that, I think that's a valid thing to do, but you have to realize that it involves risk. Number one, maybe that skillful manager will take you into otherwise riskier asset classes, or number two, maybe you'll be wrong in your choice of money manager. You know, you take on manager risk when you try to find somebody who you believe can outperform, because you introduce the possibility that they will take risk and underperform.
So you clearly sound very optimistic about the future economic outlook for the US. Do you have a list of things that make you worry that you would talk about? And in that context, how does Oaktree position itself going forward?
Well, I think the big worries in the world today are really macro worries. And in my last memo, I said that, you know, if you go back 25 years ago, if I can remember what our mindset was then, or 50 years ago, what it seems to me in retrospect was that the mindset was the world is a stable place. The background, the economic, macro, financial background is pretty stable and unchanging. There are cycles within the background, but they go away over time. But over time, the context is consistent, and you just have to cope with the cycles. I don't think anybody thinks today that the background is stable, because, you know, basically we're in a world that changes every day, mostly because of technology, automation, productivity, and also, of course, politics. So I don't think we can say that the world 10 years from now will look like the world today. And that's a source of uncertainty. Those are the great uncertainties. We used to wonder about how a company would do, micro. We would worry about whether there was going to be an excess of disk drive manufacturers or a shortage of something. But today, the uncertainties are global, and you can't diversify away global concerns, because everything that you do is affected by the global. So I think that the most important decision that we have to make as money managers, we have to come in every day and in my opinion, the most important question is not stocks versus bonds, or U.S. versus foreign, or developed world versus emerging, or even traditional versus alternative. The most important question that we have to make an answer to every day is, do we play offense or defense? Should we be aggressive today or defensive? If you make that decision right, it doesn't really matter which of the other stuff you pick. And if you make it wrong, all your selection efforts in the other stuff is not going to bail you out. So the question is today, in short, I think that the investment strategist or portfolio manager has to worry about two risks. The first is the obvious one. It's the risk of losing money. The second one is a little more subtle. It's the risk of missing opportunity, which we all have to grapple every day with those two risks. So most people compromise. Most people say, well, I don't want to lose a lot of money, but on the other hand, there's a lot of other hand in the investment business. On the other hand, I don't want to miss a lot of opportunities, so I'm going to compromise. I'm going to have a diversified portfolio with safe and aggressive components. And the important question, in my opinion, is, should we vary our position on that spectrum from day to day or month to month, year to year? Sometimes should we be more aggressive, or sometimes should we be more defensive? I believe we should. And I believe that we can do it well, and I believe that we can help our clients a great deal. Now, what's an example? Let's go back 8.5 years to the fourth quarter of 2008 in the credit world, or the first quarter of 2009 in the equity markets. What did you need to make a lot of money? What did you need? Yes? Pardon me? Courage and cash. So that's what you needed. You needed money to spend and the nerve to spend it. And if you had money and nerve that time, you made a lot of money from then to today. What didn't you need? Caution, conservatism, risk control, flexibility, discipline, patience. And in fact, the more of those things you had, the less money you made. So that was a time for money and nerve. Now let's go back to the second quarter of 2007. What did you need then? That's when you needed the caution and conservatism and risk control and all that other stuff. And if you had money and nerve in the second quarter of 2007, you got killed by the crisis. So my point is that it swings. What do you need? Money and nerve, or caution and conservatism? Aggressiveness or defensiveness? It swings. Where are we today? This is really the crucial question that every asset manager should answer. And we have had at Oaktree a mantra for the last 5.5 years, since the summer of 2011, move forward but with caution. Invest. Don't be afraid to invest. Don't be afraid to be fully invested. But everything we buy should be cautious. And we are a cautious firm, so when I say cautious, I mean more cautious than usual.
What does cautious mean? Broader diversification, better credits? How do you define that?
You know, broader diversification does not reduce general risk, because you're still fully exposed to markets. It only reduces the risk of individual positions. I would say what it means, everything else being equal, is more bonds than stocks. Your stocks should be growth stocks or defensive stocks or stable stock, not growth, defensive, stable value stocks. Your portfolio should be higher quality, and you shouldn't use much leverage. If you want to be aggressive, then you'd have more stocks than bonds, you'd have cyclical and growth stocks, you'd have a riskier portfolio, and you'd use leverage. So these are examples. In every one of our strategies, there are ways to do it more aggressively and ways to do it more defensively. And as an asset allocator, there are managers who stress maximization of returns, and there are managers who stress minimization of risk. Now, of course, what they'll tell you is that they all do both, but you should be able to tell which they really are. So you know, we have been essentially fully invested for the last 5.5 years in a higher quality, more cautious portfolio than usual. It's paid off very well. I mean, as of 5.5 years ago, when we put that mantra into place, credit assets were already fully priced, prospective returns were low, and investors trying to make high returns in a low return world were engaging in pro-risk behavior, which should be worrisome to us. And I think that, fully invested with caution has been a good place to be over this period. I think that the last 5.5 years have done better than anybody expected 5.5 years ago. I think last year is a great example of a market that did better than most people expected. If you know, at the beginning of last year, there were all these worrisome things in the world. All the uncertainties that exist today existed then, plus people were concerned about falling oil prices and rising interest rates and all these things. And the markets got off to a horrible start at the beginning of last year, January, February. And it would have been very tempting last year to say, you know, we're going to put 30% in cash. It would be a huge mistake. You know, if you weren't fully invested last year, you had a hard time keeping up with the markets, most of which did quite well. And the positioning of being cautiously fully invested was very helpful last year. And that's where I would stay today, although prices are a little higher today than they were a year ago. And some of the risks, like political risk in the US and in Europe, England, and maybe France, and maybe Germany are higher. So maybe you should be even a little more cautious. But it's all a matter of where you are on the pendulum. And so I have felt that if 10 is defensive and 0 is aggressive, I would have thought I should have been 6 or 7 over the last 5.5 years. And today maybe 7 or maybe 8, because we still have a lot of uncertainty, high asset prices, low prospective returns, pro-risk behavior, which is not a very inspiring combination.
Okay, thank you for that. I'm sure there are questions from the audience. I'd like to spend some time with some questions for the audience. Usually we would have some microphones.
But you don't need it, nobody's speaking.
I'm sure there are some questions.
Yeah.
What do you think about softening covenants in the high yield market? Might this be a risk going forward?
Well, softening covenants are a risk because the company is freer to do what it wants, that is to say, the company is free to take actions which increase the risk to bondholders. But softening covenants are also a symptom of a world in which people are doing risky things to make return. And that should be worrisome. You know, Buffett says, the less prudence with which others conduct their affairs, the greater prudence with which we must conduct our own affairs. And when other people are unworried, we should be terrified. And when other people are terrified, we should be aggressive. But I think that the ability of companies to issue bonds with reduced covenants is indicative of an environment which is more receptive to risky investments. It should be worrisome. And if you go back and read the memo I mentioned from February '07 about the race to the bottom, that was largely about a weakening of structure and an increase in risk. So it's definitely something to watch for. And this is one of the important things that contributes to my defensiveness. Yeah. Well, you know, I think a lot about the emerging markets. I just came back from 2 weeks in India on Saturday, and I go to China a few times every year and so forth. And the more I think about it, the more I conclude that you can't prove anything about the emerging markets. All you can have is a hunch. And the question is, are you a believer or not believer? And I read a great quote the other day from somebody applying to a very different topic who said, "For he who believes, no proof is necessary. For he who does not believe, no proof is possible." So the question with the emerging markets is, do you believe or not? And I don't think that it is subject to a highly analytical process. I happen to be a believer. And what I believe is that pardon the expression, Europe and Japan are senior citizens in economic terms. The US is a mature adult. And the emerging markets and China are adolescents. Now, there are some people in the audience who are old enough, like me, to have raised adolescents. And you know that if you have an adolescent in your house, it's chaotic, it's volatile from day to day, but you also know that your adolescent best decades are ahead. And if you're an economic senior citizen, your best decades are behind you. I happen to believe that the emerging markets are adolescents, which means there will be chaos, there will be bad months and bad years, but I believe that when we meet 20 years from now in this room, we'll find that the emerging markets grew faster than the developed markets. Now, you can always say, well, how can they grow fast if we're growing slow and we're their customer? That's a bit of a catch. But on the other hand, I do think that their indigenous demand will increase and cause business to do better. So that's my belief. And you know, I believe in the emerging markets. I believe in what are called the frontier markets, which are the infants today. Remy?
You mentioned earlier that you think there will be interest rate hikes, and there will be slowly and based on a positive economic environment, at least in the US. And you said that there are no inflationary risks. So, I mean, I think the European Central Bank is very expansionary, the Japanese are expansionary, we have a huge debt burden also in the USA, but you quite ignore just the inflationary pressure.
Well, I didn't say there's no inflationary risks. What I said, I think, or what I should have said, is I don't think we're going back to hyperinflation. You know, inflation, first of all, let me just say, I've lived, as Volcker says, through the 70s, then we needed the other Volcker, right? Because we had inflation at 16% a year, and you know, I had a loan outstanding, and where I get a slip, it was 3/4 over prime, if anybody remembers prime. We didn't have LIBOR, But I would get a slip from the bank each time the rate changed, and I kept the one, and I framed it. It says the rate on your loan is now 22 3/4 over prime. So those were hyperinflationary times. As business strengthens, we should have an increase in inflation. The two go together, especially as the slack goes out of the economy and unemployment declines. Then the workers can demand an increasing wage, and that should contribute to inflation. But the point is, do you think it's going to, if it's 1 or so today, do you think it's going to get to 3 or 4? Or 6 or 7, 8? Or 12, 13, 14? Inflation is very mysterious. It's not clear what starts it. It's not clear, as was proved in the 70s, what stops it. Same for deflation, by the way. Everybody worries about deflation, but we've really only had one case of deflation in the history of the world, and I don't think we can generalize from that. But my own guess is that we do not have the vitality of business or the shortages of resources that will cause hyperinflation. That is to say, inflation above 3 or 4. That's my view. Anything's possible. All these things is just opinions, but I don't worry about that. It would take a crazy development to move inflation from 1 to 7. Yeah.
What's your view of the EU? Do you think 10 years from now the EU in its current form will still exist? And if not, is that going to be a disorderly process?
You know, and this is an example, the outlook for the EU. This is an example of the risks we face today. They are cosmic risks, and they are risks in which there's no history. You know, we've never been through this before. The EU was a first-time thing, and the dismemberment of the EU, if it happens, would be a first-time thing. Just like, by the way, the reduction of interest rates to 0, keeping them at there for 6 years, and the existence of 12 trillion of negative interest rate bonds. This is, and putting 15 trillion on the central bank balance sheets. These are all first-time experiences. Nobody can tell you how this is going to unwind. Anybody who tells you how it's going to unwind is a quack. I always quote nowadays from Edward R. Murrow, who was a great newscaster in America when I was a boy, and he was one of the most trusted people in America. And he once said, if you're not confused, you don't understand what's going on. And I believe that's true about all these subjects. If you're not confused, you don't understand what's going on. If you think that the world is straightforward, understandable, and predictable, you don't know what's going on. And so I think all these things are uncertainties. The EU. The funny thing is, if you go back 6 years, everybody thought the risk was Greece. And that seems to have been solved. And I don't think anybody at the beginning would have said, no problem with Greece. But here, now everybody assumes Greece is not a problem for now. There seem to be a lot of threats to the EU. Brexit, that'll test it. And then, if Brexit leaves, will other states leave? And there's no mechanism, there's no orderly mechanism for taking Europe apart. I always say that those of us in our business, when we put out a fund, we have a 100-page document that describes the fund to the investors. The first 10 pages talk about what the fund will do and who will run it and how and so forth. And the last 90 pages are what happens if something goes wrong. And they left out those 90 pages. You know, they assumed it would be a harmonious, successful experiment. And so, I don't know. But I mean, the question is, what percentage, if you know, what I would say to you is, what do you think is going to happen? And you'll tell me what you think is going to happen. Then I would say, okay, how much of your wealth would you bet that you're right? And it shouldn't be a big percentage. Anything can happen in Europe as far as I'm concerned.
What do you think about the price of gold?
Well, this is the right place to talk about that. I put out a memo, I think it was in 2010, called All That Glitters, because everybody was very enthralled with gold at the time. And what I said in there is that if an asset produces cash flow, a stock, a bond, a company, a building, you can put a value on it. If an asset does not produce cash flow, gold, oil, paintings, diamonds, you can't put a price on it. It can sell any place. Depends on how much the buyers will pay for it and how much the sellers demand to let go of it. But you can't put an intrinsic value on gold, in my opinion. Now, the funny thing is that everybody says, I think gold will go up. I think gold will go down. But in order to be analytical about it, you have to have a way to predict fundamentals and then turn that into a price, as we do with cash flow producing assets. And I don't think there is an analytical way to be right about gold, you know? With any investment, the attractiveness of the investment depends on the relationship between the price today and the intrinsic value today. And if the price is below the intrinsic value, we think that's a bargain. It'll probably converge. You'll make money. If the price is above the intrinsic value, we think that's dangerous. It'll go down, converge in the other direction. What's the intrinsic value of gold? I don't think you can say. So what I said in the memo, as I recall, because it's a long time ago, is that you can buy it to hedge your uncertainty in the sense that, well, I don't know what makes gold work, but maybe something does. I don't want to tempt the fates by not having any. It's kind of like superstition, you know? But people say you should buy gold as protection against uncertainty and chaos. Well, the answer is, what makes gold a good instrument for protecting against uncertainty? What is it about gold that makes it a good hedge against uncertainty? And the answer is, well, it always has been. Well, but why has it been? Why did it work in the past? You can't say. All you can say is it always has been. So you can buy it in the belief that since it always has been, it always will. But if you can't explain the process, then I don't think that is such a thing as scientifically or analytically or intellectually investing in gold. That's my opinion. Now, the quote I used before about, I said, for he who believes, no proof is necessary, and for he who doesn't believe, no proof is possible. That absolutely applies to gold. Maybe more than anything else. Well, actually, one other thing. So I said, if you take gold and you take away the L, what do you have? God. Do you believe it, or do you not believe? And you can't convince the atheist that God exists analytically, and you can't convince the religious person that God doesn't exist. It's the same with gold, in my opinion. So, most of us would probably accept what I just said and agree and nod, but on the other hand, most of us have a religion that we follow. And I wouldn't say we follow it analytically. So the point is, if you superstition makes you want to invest in gold, be my guest. But don't deceive yourself into thinking you're doing it analytically. And, just remember, you may say, well, gold's been down from 1950 to 1250, wherever it is today, and it's been down for 6 years, so it's probably cheap. But just remember that the people who bought it at 1950 thought it was cheap. So I don't know how you reach a conclusion that gold is attractively priced today.
This is good. 2 more questions.
Pardon me?
We got the point that you don't really like gold.
I like it for you.
Sorry, what are the signs you're looking out for that make you turn outright negative on financial markets?
Well, I mean, I'm pretty negative already, but I think still higher prices, and still, one of the positives about today's market is that nobody's very bullish. You know, the thing that if you're the high bidder, you get the book today, and there's a chapter in the book which says, see, I don't believe in forecasts. Where's the economy going? Where are interest rates going? Where are the markets going? I don't believe in forecasts. We don't know what the future holds. But there's a chapter which says the most important thing is knowing where we stand. In other words, we don't know where we're going, but we sure as hell ought to know where we stand today. Where are we in the cycle? Relative to, if this is terrified behavior in which bargains are available every place, and this is euphoric behavior in which everything's overpriced, we should have a sense for where we are in that cycle. So, where are we today? I think that we are above the midpoint, but I don't think that there's euphoria. If you watch TV, there's nobody on TV saying, this is the last chance you're ever going to have to buy stocks. A year from now, if you haven't bought stocks today, you're going to be kicking yourself. The Dow is going to double. Remember the Dow? You remember in 1999, there was a book published, Dow 36,000. Nobody's reprinting that book today. Jim Glassman wrote that book. But the point is, one of the few good pieces of news today is that there is not euphoria. Now, I believe that even though most people are not thinking bullish, most people are acting bullish, and they're acting bullish because they have to get a high return in a low return world. Most people are taking risk. But if sentiment turned more optimistic, that would be worrisome. The other thing I would look at is spreads. Today, I believe the spread is 450. The normal spread on high yield bonds has been 350 to 550 in my 38 years of experience. If the spread went to 250 again, I would think that would be very scary. But it's not there. So that's why I am moderately defensive.
Back to China. Do you think China is where US was in 2007?
I don't think so, because the U.S. in 2007 went through a financial crisis of shenanigans on Wall Street, and most of the problems were centered in the financial institutions, and I had something else I wanted to say. Well, let's stop there. Financial. I think that the general economy was not in doubt in 2007 or 2008. Now, the financial crisis in the institutions created problems in the general economy and a recession, obviously. But the problem was not based in the general economy. I think that China has serious problems about the. Now, I happen to be a believer, as I said, but there are questions about the economy. Can it keep growing fast enough to accommodate China's needs to bring people from the farms to the cities and build itself, So in addition to financial problems of growth historically, which has been built on excess capital allocation, capital investment. So I think that China's questions are more fundamental than the U.S.'s were 10 years ago.
So one more question.
You mentioned at the very beginning that we should disconnect from the daily events news. My question is, can we afford to disconnect from the daily event, daily news? Because today consumption is driven by short-term trends and short-term news. So, or let's ask it in a different way, is the successful manager, which today is very often, let's say, a historical based analytical economist, will this person be replaced, or will a successful manager in the future being more a trend manager, a trend researcher, or let's say even an online marketing analyst person?
Well, I mean, that's a really big question, and I don't think I can answer it in a short time. But the point is, first of all, I don't believe in the prediction of the future. And I don't believe in short-term adjustment. What they call trading is, I have an allergy to. You know, trading to make money in the short term, I think, is very hard to do. I think trading more properly is what you do to implement your long-term investment decisions. You know, by the time something comes out in the newspaper, it's too late, in my opinion, to position your portfolio for it. I think it's okay to know what's going on in the financial world every day. I don't think that if you read the newspaper every day versus once a week, and if you read 10 newspapers rather than one, I don't think you're going to know more about what Trump is going to do next week than I do. So, you know, the main thing I was talking about was social media and, you know, political hysteria and that kind of thing. You know, we all want to be informed about financial trends. Well, I think we should all be realistic about what they tell us, how much we can know. I was saying, I guess I was talking to a journalist before, and I said, I was thinking this morning in my hotel room, everybody says, well, what's the market going to do? What's the interest rates going to do? What's the economy going to do? And everybody takes their positions based on that. What if you said to yourself, I don't know anything about the future? Then how would your behavior differ from the other? And then which position is right? Do you know everything? Do you know nothing? Or is it somewhere in between? And if it's somewhere in between, what do you do about it? Henry Kaufman, who was Salomon Brothers' economist during the 70s, who was called Dr. Gloom in those days, he has a great quote. He says, 2 kinds of people lose a lot of money in the market: people who know nothing and people who know everything. And so I believe that we can know very little, and we should take fundamental positions and well-reasoned fundamental positions and strap ourselves in and try to stick with them.
I think that was a very illuminated final words of wisdom from you. Thank you very much,
Pleasure.
Howard.
Thank you
Thank
all.
you for being here.